All right, so we've got the latest numbers out of India, the provisional GDP estimates for the full financial year 2024-25, plus the quarterly ones for Q4.
Yeah, straight from MOSPI, the Ministry of Statistics. These are the big ones.
They really are. So what do these data sets actually tell us about, the engine of the Indian economy right now? That's our mission today, our deep dive.
Let's do it. Pull them apart. Look under the hood.
Exactly. See the sectors, who's spending what, and what it all means, for the economy's health, policy, maybe even investment angles.
Definitely. It's like getting the economy's most recent X-ray. But it's crucial to remember what you said. These are provisional estimates,
Right. Provisional, meaning.
meaning they're based on the best data available right now. They'll likely get revised later on as more complete info flows in. So think of it as a really detailed snapshot, but maybe not the final finished painting.
Got it. The current picture, warts and all, maybe. Let's jump into the headlines then, the big figures everyone looks for. Full financial year, FY 24-25, real GDP growth.
The provisional estimate is 6.5%. That's adjusted for inflation, of course.
And nominal GDP, including price changes.
That came in at 9.8% growth.
Okay, 6.5% real, 9.8% nominal. How does that stack up against the previous year, FY 23-24? Because this is where it gets a bit
Yeah.
interesting, right?
It does, because our sources kind of frame it slightly differently. One source compares this 6.5% to the first revised estimates for FY 23-24, which were 9.2%.
Whoa, 9.2% down to 6.5%. That sounds like a pretty clear slowdown if you use that comparison.
Exactly. It suggests a noticeable moderation year on year.
But there's another take.
Yeah, another source presents the annual real GDP growth for both years, FY 24-25 and FY 23-24, as 6.5%.
Huh. So 6.5% versus 6.5%. That paints a picture of stability, not moderation.
Precisely. It just highlights how these different estimate types, provisional versus first revised, and when they're compared, can really shape the narrative. Stability or slowdown. Depends on your benchmark.
Fascinating. Nominally, though, it's clearer.
Yes, nominally it's a clear deceleration. It was 12.0% growth in FY 23-24, and now it's 9.8% in FY 24-25. So definitely slower in current price terms.
Okay, so nominally slower. Real growth, maybe stable, maybe slower, depending on the comparison point. Got it. What about the very latest quarter, Q4, Jan to March?
Now this is where we see some real positive momentum. Real GDP growth for just that quarter accelerated to 7.4% year on year.
Ah, okay. So finishing the year strongly. How does 7.4% compare to Q4 of the previous year?
It's a definite step up. One of our sources pegs the Q4 FY 23-24 real growth at 6.4%.
So 6.4% last year, 7.4% this year for the same quarter. That's a solid pickup.
It is a clear acceleration.
Okay, so the big takeaway message seems to be full year growth is estimated around 6.5%. Call it stable or moderate, depending on how you look at it. But the last quarter really pushed ahead, hitting 7.4%. That suggests strong recent momentum carrying into the new financial year.
Absolutely. And what's really revealing is looking beneath that headline GDP number at gross value added, or GVA.
Right. This shows us which specific parts of the economy are actually, generating that value, sector by sector performance.
Exactly. It shows the structure of the growth.
So for the full year, FY 24-25, which sectors were really punching above their weight, the standouts?
Construction was really leading the charge. Huge growth at 9.4%.
9.4.
Okay. Public administration, defense, and other services was also very strong, 8.9%. And financial, real estate, and professional services grew by a pretty robust 7.2%. Those are the big engines.
And in that strong final quarter, Q4, were those same sectors leading?
Pretty much, yeah. Construction was still flying, even faster, at 10.8% in Q4.
Wow.
Public admin was 8.7%, and financial real estate services clocked in at 7.8%. So you see that consistent strength there.
Okay, so construction, government services spending, financial and real estate activities really driving things. What about the other side? Which sectors were, let's say, less dynamic over the full year?
Well, on the weaker side for the year, mining and quarrying grew quite slowly, just 2.7%. Manufacturing was noticeably subdued at 4.5%. That's a key one.
Only 4.5% for manufacturing. We'll come back to that. What else?
Agriculture, livestock, forestry, and fishing managed 4.6%. Electricity, gas, water supply was 5.9%. And trade, hotels, transport, communication, that whole group came in at 6.0% annually. Though, interestingly, that trade hotels group was particularly weak just in Q4.
Okay, now we're starting to see some real contrasts. What are the most important shifts or trends you see emerging from these GVA numbers?
I think a key positive shift is in the primary sector overall, that's agriculture and mining combined. Its growth actually improved to 4.4% for the full year, up from 2.7% the year before.
So an improvement there.
Yes, and crucially, Q4 saw a major acceleration in the primary sector. It jumped to 5.0% growth in the quarter, compared to a really weak 0.8% in Q4 of the prior year.
That's quite a turnaround for Q4 in farming and mining. What does that suggest?
It suggests a pretty solid recovery might be underway in those foundational sectors, and that's really vital, especially when you think about rural incomes and the broader rural economy.
Okay, a rebound there is definitely good news. But you flagged manufacturing. 4.5% growth for the year. That really stands out, doesn't it?
It really does. That 4.5% growth, especially when you remember it was 12.3% the year before. Well, that's a sharp slowdown.
12.3 down to 4.5.
Yeah, it's definitely a significant area of concern highlighted by this data. It immediately makes you ask questions, right? Is this about cooling global demand hitting exports? Are there domestic issues, input costs, specific demand patterns? Has policy support maybe not quite filtered through to boost industry broadly yet?
It's a critical one to watch, especially for jobs.
Absolutely. Manufacturing is so key for job creation.
Okay, wow. So a dramatic slowdown in manufacturing. We've got this primary sector rebound, continued strength in construction and key services, but manufacturing looking, well, sluggish. That paints a really complex picture of where growth is actually coming from.
It really does. It shows a growth pattern that seems heavily reliant on, you see that through the construction numbers, plus public spending on services and the financial sector.
So to understand what's driving that growth, like who's doing the actual spending, we need to flip to the expenditure side of GDP, right?
Exactly. Looking at the demand components, we should probably focus on the constant prices figures here, the real growth.
Makes sense. Let's start with the biggest piece. Private final consumption expenditure, PFCE. That's basically household spending, right? What you and I buy. How did that look?
This is a very strong positive signal in the data. PFCE grew by 7.2% in FY 24-25.
7.2%? How does that compare to the year before?
It's a significant acceleration. The previous year saw 5.6% growth, so 5.6 up to 7.2. And its share in overall GDP ticked up slightly to 56.5%.
So consumers are spending strongly again.
Yes. It tells us private consumption isn't just a major driver. It has really rebounded robustly. It seems to be fueling the economy significantly from within, which is great news.
Okay, fantastic. Domestic consumer demand looks healthy. What about government final consumption expenditure, GFCE? This is direct government spending on things like salaries, running departments.
GFCE shows a very, very different picture. It grew by only 2.3% in FY 24-25.
Just 2.3%. That sounds low.
It's a sharp deceleration from the 8.1% growth seen the year before. And its share in GDP actually decreased, down to 9.1%.
And what about the last quarter, Q4? Did it pick up then?
No, quite the opposite. In Q4, GFCE actually contracted by 1.8%.
It shrank, minus 1.8%. So direct government consumption was actually a drag on growth in the last quarter and grew very slowly over the year. That's quite a shift.
It really is. It suggests perhaps a shift in government spending priorities, maybe deliberately moving away from direct consumption spending, possibly to focus more on, well, the next component.
It is.
Gross fixed capital formation, or GFCF. This is the investment spending. Building factories, buying machinery, infrastructure projects.
Right, the investment side. What did GFCF look like?
GFCF grew by 7.1% for the full year. Now, that is a slight moderation from the 8.8% growth the year before, but 7.1% is still a very robust rate. It indicates healthy investment activities continuing.
And in Q4 specifically, did it follow that acceleration trend?
Yes, it did. Investment growth really picked up in Q4, hitting a strong 9.4%. And its share in GDP also increased marginally to 33.7%.
Okay, so that strong 9.4% in Q4 ties back neatly to those booming construction GVA numbers we saw earlier.
Exactly. It really underscores that investment, probably driven quite a bit by the public infrastructure push, remains a core pillar supporting this growth story, suggests an ongoing investment cycle.
Makes sense. Okay, one more piece on the expenditure side. Net exports. Exports minus imports.
Right. So exports grew by 6.3% in FY 24-25. That's an improvement from just 2.2% growth the year before. So exports doing better. But the really big story here is on the import side.
Right. What happened with imports?
Imports actually contracted. They fell by 3.7% for the full year.
They fell by 3.7%. How does that compare to last year?
It's a massive swing. The previous year, FY 23-24, imports had grown by 13.8%. So from plus 13.8% to negative 3.7%. That's huge.
Wow. And in Q4...
The contraction was even sharper in Q4. Imports fell by 12.7% year on year in the last quarter.
minus 12.7%. So imports falling significantly.
Right.
How does that play into the overall GDP calculation?
Well, remember, net exports are exports minus imports. So if imports are falling sharply, it means net exports contribute more positively to GDP growth, or at least act as less of a drag than they otherwise would. This drop in imports provided a notable boost to the overall GDP growth figure, especially in that strong Q4. It's also favorable for India's external balance.
Okay, let me try and summarize the spending story then. It looks like growth is being really powered by two main engines: a strong rebound in private consumer spending and continued robust investment spending, particularly strong in Q4.
Right.
Meanwhile, direct government consumption spending slowed dramatically and even contracted in Q4, and the net export picture improved, largely because imports shrank so much.
That's a perfect summary of the expenditure side based on these numbers.
Now, you mentioned nominal versus real GDP earlier. Let's touch on prices briefly. That gap between nominal growth, 9.8%, and real growth, 6.5%, that gives us an implicit idea of inflation across the whole economy, right? The deflator.
Exactly, the implicit price deflator.
So what does that gap tell us about overall price pressures reflected in these GDP numbers?
For the full year, FY 24-25, doing the rough math, the implicit deflator comes out around 3.3%. For Q4 alone, it's about 3.4%.
3.3, 3.4%. That sounds moderate.
It does suggest that the overall price changes factored into these GDP calculations were relatively moderate over the period.
Okay. And what about the price indices we usually track more closely, like CPI for consumers and WPI for wholesale prices? Do the sources mention those?
Yes, one source gives some context there, points out that CPI, the Consumer Price Index, which affects us at the retail level, was running at 4.6% in Q4 FY25. That's actually down from 5.4% in the same quarter last year.
So easing retail inflation, that's good news for household budgets.
Definitely. It indicates a disinflationary trend on the consumer side. But interestingly, the Wholesale Price Index, WPI, showed a different trend. WPI inflation actually rebounded to plus 2.3% in Q4 FY25, up from just 0.3% a year ago.
Wholesale prices picking up then.
Yes, and notably, the source highlights WPI for manufactured products specifically. That swung from a negative 1.1% inflation a year ago to positive 2.9% inflation in Q4 FY25.
So retail inflation cooling, which helps consumers, but wholesale prices, especially for manufactured goods, are starting to firm up or rise again. What does that mix imply for, say, the Reserve Bank of India and monetary policy?
Well, the easing CPI, the retail inflation, certainly gives the RBI some breathing room. It makes their job a bit easier. The moderate implicit deflator from the GDP data also kind of supports this.
So maybe less pressure to raise interest rates.
Potentially, yes. While that uptick in WPI, especially in manufacturing, suggests some pipeline price pressures might be building, the overall picture probably reduces the immediate pressure for significant rate hikes. It allows the RBI to continue balancing its objectives, supporting growth, while keeping an eye on price stability. Maybe maintain a cautious stance, lean towards being growth supportive.
Okay. And just to hammer it home one last time, these are provisional estimates.
Absolutely. Need to keep that in mind. They bake in the latest Q4 data available now, but they will be refined as more complete data comes in from various agencies over the coming months and year. The final picture could shift slightly.
Right. Always subject to revision. Okay, let's zoom out then. Putting all these pieces, the headline numbers, the sectors, the spending, the prices, what's the overall economic outlook that emerges from this latest data, and what are the key policy takeaways?
I think the short to medium-term outlook looks broadly positive and pretty resilient. That strong 7.4% growth in Q4, beating expectations, provides really good momentum heading into the current financial year.
And the sources of that resilience seem clear.
Yeah, growth is clearly being propelled by strong domestic drivers. We saw the rebound in private consumption and that sustained robust investment cycle fueled by GFCF. Plus, the recovery in agriculture and mining is definitely a positive factor, potentially helping rural demand down the line.
So mostly a domestic-driven story. But what's the main caveat, the asterisk on that positive outlook?
The major area that really stands out as a potential drag, or at least a significant concern, is that sharp slowdown in manufacturing growth, down to 4.5% for the year.
Right. While other parts are booming, manufacturing is lagging.
And its revival is really crucial, isn't it, for broader economic health, for diversification, and especially for creating enough jobs.
Absolutely. So given that complex picture, what does this data suggest for policy direction, monetary policy first?
Well, as we discussed, the RBI seems to have some space now. The easing CPI and robust growth mean they can likely maintain their current cautious stance, balancing growth support with being vigilant on inflation, especially with that WPI uptick. The data probably doesn't scream for immediate rate cuts, but it also takes pressure off for hikes, supports stability perhaps.
And what about fiscal policy, the government side?
The expenditure numbers really reinforce what we've seen as a clear government emphasis.
Hmm.
Capital expenditure. You see it in the strong GFCF figures. You see it in the booming construction sector, GVA.
Right. The investment focus is clear.
But that sharp slowdown in government consumption expenditure, the GFCE, is really notable. It suggests either a deliberate policy shift, pulling back on direct spending to create fiscal space for investment, maybe, or it could just be some quarterly volatility. Hard to say for sure yet.
So what does that imply going forward?
Future policy will likely continue prioritizing this investment-led growth model, while also needing to manage the fiscal deficit carefully. But addressing that manufacturing slowdown, perhaps through more targeted interventions or policies, is almost certainly going to be high on the agenda.
And that lower GFCE growth, does that create any room?
Potentially. You could argue it might imply some flexibility for, say, increased social spending or even more capital outlays in the next budget cycle, assuming revenues hold up.
Interesting. Okay, thinking about what this means practically for people looking at the economy, maybe investors, what potential opportunities and risks seem to jump out from these numbers?
Well, based purely on the sectors showing the strongest growth, construction and infrastructure look like pretty clear opportunity areas.
Makes sense, given the GVA and GFCF numbers.
Yeah, 9.4% annual growth accelerating to 10.8% in Q4. That points not just to the big infrastructure developers, but also allied industries. Think cement, steel, heavy equipment suppliers.
Okay, what else looks strong?
Financial, real estate, and professional services. Also, very robust, consistent growth, 7.2% annual, 7.8% in Q4. So opportunities across banking, insurance, NBFCs, real estate development, maybe even consulting firms benefiting from the overall expansion in credit growth.
And connecting back to that strong private consumption story.
Absolutely. That strong PFCE rebound, 7.2% growth, should theoretically create opportunities in consumer discretionary sectors. Think retail, maybe auto, hospitality, travel, other consumer-facing services. People are spending again. Also, areas like defense and education seem to be getting strong budget support, reflected in the public admin growth.
Okay, those are the bright spots. Where should people maybe exercise more caution? What are the potential risks highlighted?
The big flashing light is that manufacturing deceleration, down to 4.5%. That's a major risk signal if you're invested heavily in industrial stocks, capital good manufacturers, or even some consumer staples reliant on manufacturing output. You really need to understand what's driving that slowdown.
Right, that's the key question mark. Other areas.
Mining and quarrying also showed pretty weak growth, 2.7% annual, even weaker, 0.8% in Q4. Doesn't suggest huge near-term prospects there.
And thinking about that GFCE data.
Yes, sectors or specific companies that are heavily dependent on direct government consumption spending might face some headwinds if that slowdown trend persists. Energy and utilities also showed relatively low momentum, perhaps indicating they need more policy support or reform to pick up.
And the external side.
Well, despite the boost from falling imports this time, India's export performance is still fundamentally sensitive to the health of the global economy. Geopolitical risks, slowdowns elsewhere, those remain external risks to watch.
Okay. So how does this overall picture generally translate into the capital markets? Stocks, bonds.
For equity markets, the headline story of robust GDP growth, especially driven by domestic demand and investment, is fundamentally positive, generally good for stocks.
And specific sectors.
You'd expect the sectors leading the charge, construction, financials, consumer discretionary, maybe capital goods, linked to that investment push to attract investor interest and potentially outperform the broader market.
And the downside.
The manufacturing slowdown is the main one. It could weigh on industrial stocks, maybe limit the upside for sectors that rely on manufacturing as a base, perhaps even some FMCG if government consumption stays weak.
Okay. What about the debt markets? Bonds.
The combination of moderate inflation, especially the easing CPI, and that stable to improving growth trajectory, that's generally supportive for the debt market. It suggests a relatively stable interest rate environment, which bond investors usually like.
Any potential shifts there?
Well, if the RBI signals a more dovish tilt down the road, perhaps focusing more on growth, then longer duration bonds could benefit. The risks, as always, would come from any unexpected jump in inflation or perhaps significant changes in government borrowing plans that could push yields up.
And for foreign investors looking at India, FDI.
I think the picture is quite positive. The strong GFCF numbers showing continued investment, the improving macro stability, the resilience of domestic demand, the buoyancy in services, it all enhances India's attractiveness for foreign direct investment.
Which areas might look particularly appealing for FDI?
Well, potentially manufacturing, if that slowdown can be addressed and reversed. Infrastructure, definitely. Fintech, digital services, renewables. Areas where India has structural advantages or policy support.
Stepping back for a moment, how did these numbers compare to what people were expecting? And how does India look globally?
Good question. That 6.5% real GDP for the full year.
That was actually pretty much in line with major forecasts. The RBI, the IMF, most analysts were predicting somewhere in the 6.5% to 6.7% range. So the full year number wasn't a huge shock.
Right. But that Q4 number, the 7.4%.
That was the upside surprise. It comfortably beat the market consensus, which was generally clustered around maybe 6.8%. So finishing the year that strongly definitely exceeded expectations. And putting that 6.5% annual growth, or even the 7.4% quarterly growth, into the global context.
It remains a very robust performance. When you look at major economies around the world, many grappling with much slower growth or even recession risks, India's growth rate stands out. And the improved external balance, with imports contracting, suggests a degree of resilience against global trade headwinds, at least for now.
Okay. So looking ahead then, based on everything we've discussed, what are the big tailwinds that could keep propelling growth forward?
I think the key ones are that strong domestic demand seems like private consumption is resilient, investment cycle is ongoing. The continued government focus on infrastructure provides a solid base. The services sector remains dynamic. Easing retail inflation helps consumers. And then there's the long-term potential from India's demographics, that large young population, if they can be effectively skilled and employed.
Those are the positives. What are the main hurdles or challenges on the track ahead?
Number one has to be reviving manufacturing growth. As we've said, it's just so crucial for creating jobs and ensuring growth is broad-based and sustainable.
Absolutely. What else?
Managing inflation remains a key challenge for the RBI, ensuring it stays anchored, especially with global commodity prices always being a risk. Then there are the external global uncertainties, potential slowdowns in key export markets like the US or Europe, geopolitical tensions. These could still impact trade and capital flows significantly.
Any other major challenges?
Well, ensuring the benefits of growth reach all sections of society and all regions, tackling that challenge of inclusive growth, particularly bridging the gap between urban and rural areas, managing external vulnerabilities like sudden oil price spikes or currency volatility, and increasingly the potential impact of climate change, things like erratic monsoons affecting agriculture, even with its recent recovery. There's also a risk sometimes noted about urban and rural consumption patterns diverging significantly.
So, if we sum it all up, the picture is one of pretty notable resilience. Growth seems quite firmly driven by internal engines, consumer spending picking up, investment holding strong. The year finished on a high note with that Q4 acceleration,
Right.
but it's tempered by the significant concern around the manufacturing sector's slowdown and obviously keeping an eye on those ever-present global economic and geopolitical uncertainties.
That sums it up very well, I think. The foundation looks pretty solid, with domestic factors providing the main momentum right now. Policy is expected to keep favoring investment, trying to balance growth with stability. It paints a picture of maybe cautious optimism, but with very clear areas like manufacturing that need focused attention.
It certainly leaves you thinking, doesn't it? Given that the current strength seems so fundamentally rooted in domestic demand and investment, but with manufacturing lagging so noticeably, what specific policy levers could actually be most effective in reigniting that particular sector? Not just for the headline growth number, but for creating the kind of jobs needed across the country. Or maybe looking outwards, if those global economic headwinds really do start blowing harder, how much can this domestic resilience truly shield the Indian economy? The data gives us a fantastic snapshot, but navigating those questions seems key to the path forward.